This was not just a bad day for stocks. It was a policy shock that exposed how fragile positioning had become. It also revealed how quickly markets can reprice growth and inflation assumptions. By the end, you will understand 7 forces that turned a tariff headline into a cascade. But first, let me show you what really triggered this. Welcome to Alpha Markets, where we decode the market. Build your wealth. The story starts with conditions that looked calm on the surface. Underneath, the market was primed for a sudden air pocket. Going into early April, the S&P 500 was near 5,900. SPY was around $580, reflecting strong momentum. Data shows that leadership was narrow, dominated by AI-linked megacaps. That concentration can cushion indices, yet it can also worsen reversals. When the leaders wobble, passive flows amplify the move. The first driver was valuation sensitivity to rates. Higher expected inflation pushes real yields up and compresses PE ratios. Tariffs are basically a tax on trade, and markets treated them as inflationary. Service prices were already running about 3.4% year over year. That meant investors had less confidence in disinflation continuing smoothly. The second driver was supply chain fragility. Even in 2025, many manufacturers still relied on cross-border inputs. A 10% baseline tariff can ripple through bills of materials. Companies can absorb it, reprice it, or redesign sourcing. None of those happen overnight, so uncertainty spikes immediately. According to SEC filings, many firms flagged tariff exposure as a material risk. The third driver was positioning and leverage. After a strong run, systematic strategies had built exposure. When volatility rises, those strategies mechanically cut risk. At the same time, dealers hedging options can sell into declines. The result is a feedback loop that turns a headline into forced selling. The numbers tell a different story than fundamentals in the moment. The fourth driver was the historical echo. Investors remember 1930 Smoot-Hawley and what followed. They also remember the 2018 trade war, when the S&P dropped about 10% over 3 months. So when protectionist language returned, the market assigned a higher tail risk. Historically, this has meant wider credit spreads and a stronger dollar. Both can tighten conditions quickly. The fifth driver was global synchronization. This was not an isolated U.S. story. Export economies, commodity channels, and currency markets all reacted together. When global risk assets move in lockstep, diversification fails. That raises the value of cash and volatility hedges, at least temporarily. It also increases the chance of circuit breakers in futures markets. The sixth driver was communication risk. Tariffs are policy, and policy can change overnight. Unlike earnings, policy is not a smooth data series. One press conference can reset expectations for growth, inflation, and margins. That is why the market hates uncertain policy more than bad policy. Investors can price bad news, but they struggle to price shifting rules. The seventh driver was sector vulnerability. Tech and manufacturing were hit hardest in the initial shock. Tech because discount rates matter and global revenue is exposed. Manufacturing because inputs and export demand get squeezed simultaneously. Data shows that manufacturing employment declined each month after April. That reinforced the narrative that tariffs were biting faster than hoped. Now we get to the trigger itself. On April 2nd, 2025, the White House announced Liberation Day tariffs. Futures immediately slid about 3.9% on the S&P. The plan set a 10% baseline tariff effective April 5th. Higher country rates were slated for April 9th. Markets had expected negotiation theater, not a hard timetable. On April 3rd, the selling became disorderly. The S&P fell about 4.88%, a massive point drop. The Dow fell about 3.98%, and the Nasdaq about 5.97%. Overseas, The Nikkei dropped about 2.8%, and the DAX about 3.1%. Nasdaq futures were down about 4.7% at one point. Liquidity thinned as bids stepped back. But here is where things get interesting. The cascade unfolded in waves, not one straight line. First came the index selling and volatility spike. The VIX pushed higher, eventually hovering near 25. As volatility rose, risk parity and trend strategies reduced exposure. That selling hit the same mega cap names that had carried performance. At the same time, corporate bond spreads widened modestly, signaling tighter conditions. Second came retaliation risk. China responded, and tariff rates escalated sharply. U.S. tariffs on China goods reached about 145%. China tariffs on U.S. goods moved to about 125%. That raised immediate fears of a demand shock and margin compression. Multinationals faced the possibility of sudden pricing changes across regions. Third came the mechanical market plumbing. On April 7th, Japanese futures hit a circuit breaker after an 8.03% fall. That matters because global volatility transmits through hedging and currency moves. When Asia breaks overnight, U.S. traders walk into a different regime. That morning, implied volatility stayed bid and credit hedges got expensive. But here is what most people miss. The crash was not only about tariffs. It was also about the market realizing it had been underpricing policy volatility. Investors had treated trade risk as a negotiating tactic with a quick resolution. When the schedule looked real, the probability distribution widened dramatically. Drop a comment. Do you think tariffs are mainly an inflation story or mainly a growth story? I read every comment. Your answer changes how you interpret the same headline. If it is inflation, rates matter most. If it is growth, earnings matter most. In reality, it can be both. Next came the key decisions that shaped the path forward. The White House suspended the April 9th increases for negotiations. That signaled flexibility, even as rhetoric stayed tough. By July 31st, deals were announced with 8 partners. Those included the UK, Vietnam, the Philippines, Indonesia, Japan, South Korea, the EU, and a China truce. Bulls argue this proved the tariffs were leverage, not a permanent wall. Now, to be fair, bears counter that the damage was already done. Costs spiked for U.S. manufacturers, and job losses totaled about 73,000 since April. Manufacturing employment declined month after month. Firms do not rehire instantly after uncertainty clears. Bears would argue that the economy absorbed a hidden tax. They also point to inflation risk from higher goods prices. Federal Reserve communication mattered too. Jerome Powell at the Federal Reserve said tariffs and economic impact were significantly larger than expected. That line fed the fear that policymakers were behind the curve. Yet later, the Fed cut rates 3 times in the second half of 2025. Bulls counter that those cuts helped stabilize financial conditions and supported a rebound. Janet Yellen, former Treasury Secretary, warned that fiscal dominance from tariffs risks higher volatile inflation and elevated borrowing costs. That is the bear case in one sentence. If tariffs raise prices and deficits widen, long rates can rise. Higher long rates can offset Fed cuts and pressure valuations. The risk here is a tug of war between policy support and inflation expectations. And that is when the market revealed the truth. The truth was that fundamentals did not collapse as much as the tape suggested. Q3, GDP printed about 4.3%, surprising many. An analyst at JP Morgan said initial recession odds of 60% proved overstated. Meanwhile, CCR Wealth team at CCR Wealth argued markets outperformed expectations despite tariff fears, as offsets like negotiations and tax cuts materialized. Bulls argue this is why the S&P finished the year up about 18%, despite the April crash. If this analysis is helping you, hit that like button. It helps more people find this content. Also remember, fast moves can distort perception. One day can feel like a regime change, then fade into a longer trend. That is why process matters more than panic. The aftermath was messy but instructive. After the initial drop, markets chopped as headlines shifted daily. Relief rallies followed negotiation hints, then sold off on retaliation news. By late summer, reciprocal tariffs resumed on select countries. Yet the recovery phase still outperformed many non-U.S. equities. That suggests U.S. earnings resilience and policy support remained powerful. And this is where it gets really interesting. The same event created both a warning and a blueprint. The warning was that policy shocks can erase trillions quickly. The blueprint was how fast markets can rebound when uncertainty narrows. Bulls argue AI-driven mega-caps insulated the index. They note that cash flow-rich leaders can absorb tariffs better than cyclicals. Bears counter that concentration is a vulnerability, not a shield. If leadership breaks, the index has fewer supports. As always, this is educational content, not a recommendation to buy or sell anything. Investors might consider stress testing portfolios for policy shocks. That could mean thinking about sector concentration and revenue geography. It could also mean understanding how volatility products behave in spikes. The goal is preparation, not prediction. So what lessons stand out from the 7 causes? First, tariffs hit both inflation and growth narratives. Second, positioning can turn a rational repricing into a stampede. Third, global markets transmit stress faster than headlines. Fourth, policy communication can be as important as policy itself. Fifth, sector concentration changes index behavior under stress. But there is one more thing you need to understand. What to watch now is whether the truce framework holds after August. Renewed escalation is a real risk if talks fail. Watch service inflation, still running hot, because it constrains the Fed. Watch labor data, since dismissals were up about 60% in 2025. And watch corporate guidance for margin pressure tied to input costs. According to SEC filings, more firms are quantifying tariff exposure in risk sections. And this changes everything for investors. If tariffs return, the market will likely price them faster next time. Volatility could spike sooner and liquidity could vanish earlier in the session. Bulls would counter that the playbook is known now, so negotiations may arrive quicker. Bears would argue that repeated shocks erode confidence and cap valuations. But there is another way to look at this. A market that survives a policy shock can become more resilient if earnings hold. The tariff crash shows us that policy shocks can move markets faster than fundamentals, but fundamentals still matter over time. Share this with someone who needs to understand tariff-driven volatility. Drop a comment. Are you bullish or bearish on tariffs and the market outlook? I read every comment. Hit like if this analysis helped, and subscribe to Alpha Markets for weekly market breakdowns. Next week, we break down volatility spikes, circuit breakers, and why they matter for your portfolio.